we have the second speaker, Prof. Allen from Hong Kong Polytechnic University. Prof. Allen is a professor and associate head of the Department of Computing, the Hong Kong Polytechnic University. His research covers information security, cryptography, blockchain, and their applications. He has won a lot of 6 Best Speaker Awards at the international conference and the PET Runner Awards for research in privacy enhancing technology. His team has won the International Z Prize competition twice, receiving a total prize of $800,000 US. And he is also the winner of 2023 AOC Hong Kong Science and Technology Innovation Prize in FinTech category. Now, he's going to talk about each of the issues in CBDC. Thanks, welcome, Prof.
Thank you for the kind introduction and invitation. It's an honor to be here to talk about some of our reasons with the Hong Kong Monetary Authority on central bank digital currency. In particular, we try to apply, because I'm also coming from a cryptography background, we try to apply some of these cryptographic techniques to improve the privacy of central bank digital currency. So to begin with, so it starts like this. So why so many central banks around the world are talking about central bank digital currency these days? Actually, one of the reasons is related to the rise of all these cryptocurrencies. Now, back in 2021, we witnessed a surge in the cryptocurrency. The total market cap for cryptocurrency is like 3 trillion, and by comparison, it is already more than the USD in circulation. So at that time, the central banks had to feel, okay, well, this might be a competition. Indeed, in one country in Central America, Salvador actually says, okay, we adopt this Bitcoin as the national currency, as the legal tender, to try to, I guess, reduce the impact from US dollar. So, at this moment, as of now, at the 19th of the 2020, central banks are investigating, researching on the use of using digital currency, the fiat version. And then there are lots of countries, like 3 countries already launched CBDC in actual use, and 36 in advanced pilot stage. So why? Well, of course, I just say it's related to the challenge brought about by the cryptocurrency. But of course, there are a lot of advantages that people talk about when they say central bank digital currency. There are a few potential advantages, including reduced transaction costs. So I think yesterday a speaker also mentioned the project Ambit, which is led by mainland China Central Bank and also Hong Kong and Thailand and both banks. They join together and make use of blockchain to create an advanced prototype to allow the banks of those jurisdictions to do a cross-border transfer, and indeed it can reduce transaction costs. And then financial inclusion. So in Panama, where central bank digital currency already issued, is a country consisting of thousands of islands, and as you can imagine, it's difficult for the banks to operate branches in each of these islands. So with a central bank digital currency, it enables people to enjoy this payment and also financial services more easily. As long as you got a cell phone, you can enjoy a number of banking services. And it improves monetary policy implementation. One of the most radical examples that people discuss is, okay, if we have central bank digital currency, the central bank can even impose negative interest rates, so to force people to do spending. Of course, they are not going to do this, but it's just a possibility to say, okay, with CBDC, the central bank got more power. And also facilitate fintech innovation. That's also an interesting aspect, especially function. So here with CBDC, we can do something more efficient or enable new services, such as in some countries or in some of the cities like Hong Kong, sometimes the government will issue consumption voucher to the citizens and encourage them to do spending, and this voucher can only be used to buy things in a certain eligible retail sectors. And with CBDC, and of course with smart contract, this thing is now doable, but without CBDC, it's actually pretty difficult for the government to issue this kind of consumption voucher. So it facilitates innovation. Now, there are a few types of CBDCs or different architectures. And for system participants, we have the central bank, we have the commercial bank, and interestingly, different from the cryptocurrency world, we have a new completely decentralized blockchain, and then we have tokens built on top of it. For central bank digital currency, they follow a more traditional approach. So we have central bank, and then we have the commercial bank, and then the normal user like payee. And there are three kinds of architectures. One is the direct CBDC. In this case, the central bank operates the system. They then handle all the retail payment and onboard all the customers. This is not a very popular model. And the other one is called the indirect CBDC. In this case, the CBDC, the token, are still a direct claim over the central bank. However, for the indirect CBDC, actually there are two layers. One is the wholesale layer, so the bank deposit money in the central bank, and then they can issue their own token. So those tokens are actually direct claim over the banks rather than the central bank. And then, of course, the banks will handle the payment from the customer. And finally, we have the hybrid model, in which the CBDC are direct claim over the central bank. However, the onboarding of the consumer and also the handling of the daily payment is by the commercial bank. So it seems that the hybrid and the indirect approach is more appropriate for the retail sector, but for the wholesale layer, it's still the direct version. Now, today's goal is to talk about this privacy issue. Interestingly, when we discussed with the Hong Kong Monetary Authority, they said they are not building CBDC to monitor people's payment, to monitor people's daily spending. Actually, they also respect the privacy of the user. They would like to convey the message that they don't want to know your spending habit. Actually, so from this point of view, then we start to discuss with them and discuss what are the possible ways to improve the privacy of CBDC. And actually, this is a major technical challenge. Usually people, at least from the government, they say maybe we can use legislation, some kind of rule-based approach to protect user privacy. But in the cryptocurrency world, we know that actually we can use a technical approach to protect the privacy of the user. Just then, Joseph also mentioned, let's say, ring signature. We can manually use this ring signature to protect the user privacy. So during the discussion, we also agree that privacy by design is very important, and we would like to come up with some ideas on what kind of technologies can be used to improve the privacy of CBDC. Now, to talk about privacy of CBDC, we have to discuss some concept. What do we mean by privacy? In a CBDC system, we have holding and also transactions. So holding refers to each holding that are owner and also the balance. So that means you have an account in your bank and you have an account balance in your bank, and then there are lots of transactions happening. So for each transaction, there are at least information related to the payer, the payee, and the transaction amount. So when we talk about privacy, at least we can define three kinds of privacy. One is the holding privacy. So, well, of course, from our point of view, we do not want others to know holding privacy, and then transaction privacy. There are three types of information here: payer, payee, and transaction amount. And in the ideal case, we would like to hide all of them. So when I go to a shop to buy something, maybe I don't want others to know how much they pay. And more importantly, most likely, I don't want people to know what I buy easily. And when I receive money, I may not want to reveal who actually sent me the money. So we may want to hide both the payer, payee, and the transaction amount. And finally, when we do transaction, we have some kind of account number. And is there any way to reveal the legal identity behind that account number so that identity privacy? So to recap, when we say we would like to protect or improve the privacy of CBDC, we would like to protect both holding privacy, transaction privacy, and identity privacy. And somehow the definition could be, in the crypto way, we would like to make sure no information is leaked. Roughly speaking, there are things that shouldn't happen. So when people observe a transaction, they should not know who the transaction sender is, who the receiver is, and also the amount. And more importantly, even two transactions, we do not want people to tell if these two transactions are originated by the same sender, and also we don't want people to link the payee of the transaction, so we do not want people to know, okay, these two transactions, the receivers are the same guy. So this is also a requirement in the privacy. Now, this is something I actually wish to get more comments from all the audience and all the experts. So here, when we discuss with different parties, different stakeholders, this is the requirement of privacy. What should people know, and who is involved in each of these things? So in the case of central bank digital currency, we have a central bank, which is the system operator. Well, they say that, okay, for each transaction, they don't actually need to know the payer's legal ID, they don't need to know the payee's legal ID, they don't need to know optionally, they don't even need to know the payee's balance or the amounts in each transaction. So it might be optional, it might be required depending on the legal requirement. And for the validator, it's similar. So they don't need to know the legal ID, but in some cases they may need to know the amount because of the KYC requirement. Maybe the transaction amount is high, then they need to know the amount. Now, for the CBDC, that's different from classical cryptocurrency. In the transaction, the payer's bank and the payee's bank needs to know the transaction amount, the payer and the payee, and also for the payer's bank, they need to know the payer's legal ID, but not necessarily need to know the payee's ID. And likewise, for the payee's bank, they need to know the amount, the payer, payee, not necessarily need to know the legal ID of the payer, but need to know the legal ID of the payee. They don't need to know the payer's balance, they need to know the payee's balance. So this is different from, let's say, Zcash or Monero, where everything could be hidden, because the bank needs to know whether or not the person is legal and needs to be able to trace these transactions. For all the other participants in the system, if the transaction is not related to them, they shouldn't know anything. So basically, that's a requirement that we come up with. Now, we have some different stakeholders' point of view. From the user's point of view, actually the user's preference kind of varies. Some prioritize personal privacy, but many others favor efficiency or convenience. There is a study conducted by my colleagues that, for people in mainland China, they have a lot of digital wallet, and the wallet that is most popular or the wallet that they choose would be the one that offers most discount or coupons, rather than whether or not they are most secure or most efficient or most promise the most privacy. So if the preference depends also on the transaction type. If I'm simply buying a coffee, then of course I don't care too much. But if I'm buying some prescription also depends on the entity that collects the information. Maybe I choose a particular bank that I trust the bank to handle my information, but I may not trust the central bank, or I may not trust the other bank, so I don't want them to know my information. For the regulator, what they concern most is, okay, you can have these privacy protecting or privacy enhancing technologies placed there, but I still need to be able to detect and prevent criminal activities. And then, in case of court order, I may be required to do the auditing and trace the transaction. And for most of the government, they say, okay, if the transaction amount is more, then I don't care, but if it is large, I need to be able to trace everything. And for the commercial bank, they need to be able to carry out the KYC, CFT, due diligence, and also do transaction screening. Now, kind of like more like the meat of today's talk, what are the technologies that are available? Well, we can classify them according to what they do. Some of them belong to the category of altering the data. Maybe you use a pseudonym to represent each user. Some of them depends on the shading of the data, like you use serial Prof or MPC or hardware solution or homomorphic encryption to encrypt the data. And then another possibility is to design the system well in machine learning. You can say, okay, separated learning may be a way to help improve the user privacy. Maybe we have digital identity provider that is separated from the system, or maybe we do some kind of transaction mixing. Now, for today's talk, let's just start. Okay, how do we compare these technologies for CBDC? Well, we can compare them according to 4 criteria, like generality. We discussed ID privacy, transaction privacy, and holding privacy. Can the technology be used to protect all of them, or only a subset of them? And maturity, are these technology tested, well tested, or is it already in use in some other situations? Is it efficient? And finally, is it easy to implement and integrate into the system? So we compare these technology according to these 4 categories. And this is another one that I guess I would like to solicit comments or suggestions from the audience. So pseudonym. I think pseudonym is kind of very mature, very efficient, and also very simple. But it's not general in the sense that pseudonym cannot protect the holding privacy because it does not have the amount. It also cannot protect transaction privacy in the amount. And also it does not provide full privacy because if I use a pseudonym for many transactions, then people can still trace me. And then there are some crypto solutions like group or ring signatures, not extremely general, kind of not too mature, but kind of freestyle still mature enough, still simple. Encryption, homomorphic commitment, they are used in some of these privacy preserving cryptocurrencies. And then bisignature is not that general, MPC is more general. Another one that is pretty general is serialized proof, in particular. It can be used to protect all the ID privacy, transaction privacy, and holding privacy, but it's not simple, not really scalable, and not that mature. So on and so forth. So this is a brief comparison. And from here, we will focus on pseudonym and CKP in the next couple of minutes. So pseudonym, as the name suggests, we simply replace something with an identifier, which is largely used. It can be used to provide some kind of ID privacy. And it has been used in Bitcoin and Monero in stamp address. It has been used in our traditional industry, like credit card payment tokenization. So if you check your kind of like Apple Pay, when you use it to pay your merchant, the merchant didn't really see your actual credit card. Rather, it's a DAN number, which is the number generated when you register your card to the Apple service. It replaces your credit card number with another number. So this is also a kind of pseudonym. Consider is another project carried out by RMA, which study the use of pseudonym in CBDC. So we'd like to dive a little bit deeper into this pseudonym for cryptography like staff address in Bitcoin Monero. There's still some difference between these two, or in general, you may ask the user to generate a lot of pseudonyms and then give it to different payees so that they cannot link the payer. So this is kind of like user initiated. It can also be the case that, okay, I publish a long-term public key, that's my pseudonym, and then everyone would like to pay me money. They randomize my public key and then use the public key to encrypt that random number, and then pay money to that randomized public key because I myself can decrypt the random number and de-anonymize the value, so I myself know, okay, this is for me, but for other people, they cannot tell if the transaction is targeting for me. So here, in this case, I only have one long-term public key, and it's the sender or the payer who do the generation of the pseudonym for the payee. So both cases are possible. And strings, of course, is simple and easy to implement. And payment tokenization has been used since, 1970s. It's in our mobile system as well, but it does not provide transaction unlinkability. If I use the same pseudonym, then people can tell, okay, that's the same guy, even though they don't know my real legal ID. And also, if the pseudonym is not reversible, then it may contradict the AML CFT requirement. Now, the other technology that could be used is the CKD. Well, it's powerful cryptographic techniques which allows people to prove any claim about computational statement without looking at any extra information. It's a very general tool for anything that you can prove, then it can be proved in zero knowledge. Some example include a range proof. I can, let's say, encrypt a value and number or put it in a commitment and then issue a zero knowledge proof that the number encrypted corresponds or satisfies a certain property, such as within a certain range. It can also be used to hide the sender of the transaction. It's used in Monero asset class and also Ethereum support this CKD. So I may encrypt my own ID as the sender and prove and issue a zero knowledge proof that, okay, the value encrypted is one of these possible senders. Now, it's very powerful, but it's very complex and difficult for non-expert to design, and actually difficult for non-expert to understand this concept. And also, the state-of-the-art CKD, which we call CKSNAP, pretty new. So there are also one more point I would like to talk about before we go to the case study in Hong Kong. So here, actually, the architecture of CBDC also has some impact on the privacy technology that we can use. If the system is permissionless, the consensus protocol is permissionless, then we need cryptographic protection. If it is a permissionless system, maybe we can use segregation of data. Each of the validator and the system maintain some part of the data, but then we have privacy against the validator, so we trust them. If it is a completely centralized system, if the central bank itself holds everything, and then maybe people trust the central bank, then we don't have much privacy concern, but we need a very strong trust assumption. Another issue is, what kind of data model do we use? If it is a UTXO model, which is used by Bitcoin, it's actually easier to implement this privacy-enhancing technology. But if it is the account-based model, like one that is used in Ethereum, it's actually more difficult. The reason is that in UTXO model, every UTXO is used only once, so you only need to protect the kind of whether the transaction privacy is sufficient. But in the account-based model, everybody got an account and then the balance will be updated after each transaction. So in that case, even if you can hide everything in the transaction, more than sending, receiving money, then you need to use more tricks. Maybe use a trust hardware solution, or maybe you need to ask somebody to run the smart contract and produce a secret key that this is the outcome. And maybe you try to separate the data to different entities and trust that they won't pollute. Okay, final part is to talk about what has been done in Hong Kong. This is the Project Orum, which is supported by the BIS Innovation Hub and the Hong Kong Monetary Authority. They built a two-tier system. The first tier, this one, is a wholesale CBDC. And the second tier is the retail CBDC. So they rely on the commercial bank to work with those customers because the central bank does not want to handle the retail payment themselves. And its participants can have a mobile wallet and go through their favorite commercial bank, and that's account there. And from there, all their transactions are actually orchestrated by the bank, not by themselves. The only thing that they keep is the signing key, the private key. They keep the private key in their own mobile wallet, so the bank cannot steal their money. So the bank will prepare when the user wants to spend money, they need to contact their own bank. And then the bank will prepare the transaction and then send the transaction to the user app. The user app will sign the transaction, and then this bank will submit the transaction to the validators. At this moment, they are not using blockchain. Only the average, the wholesale layer for cross-border payment is using blockchain. For the retail payment, this set of validators are more like centralized trusted entities. So they will inspect the transaction and say, okay, this is valid, then they will sign it. After that, they will send it to the receiver bank, and the receiver bank will verify this transaction and notify the user, okay, you receive money. So this is using the UTXO model, and the difference between cryptography and this Project Orum is that this is not blockchain-based, but a lot of stuff are kind of similar. They are still using the UTXO model, allowing the user to sign the transactions. So to look into some details, there is a coin-based transaction, the validator sign, and to assign a certain coin to a certain owner with certain value. Of course, each coin has its own randomness. And in the system, the coin ID is simply the hash of this thing, the hash of the coin. Now, for each transaction, it actually looks like this. I guess for those familiar with Bitcoin, you will recognize this diagram. We simply replace the transaction being placed on the Bitcoin with a signature from the validator. So it supports multiple input, multiple output. Let's say 2 input, 2 outputs. So the input is some of the existing calls that has already been seen. They are captured by the validator. And then the regular transaction will specify, okay, I'm going to spend these 2 calls, or the so-called UTXOs. Then I can produce new UTXOs or new calls. Of course, to make sure this is valid, so this call is owned by this guy, so this transaction should be signed by this guy, and this one is owned by this guy, so also signed by this guy. Now, the transaction flow looks like this. When the senders want to send money to a receiver, the senders ask the sender's bank to prepare the transaction. So this is a kind of like a blank transaction. The sender will say, I would like to send money to 04 and 05 with this amount V4 and V5. So the sender's bank will look for, okay, these are the calls belongs to the sender, and the 01 and 03 are both pseudonym or account of the sender. And prepare this transaction, then send this to the mobile app of the sender. The sender say, okay, I will use my secret key to sign this transaction. So because this transaction involves these 2 input calls, so signed by the owner with this and this secret key. And after that, the bank got this transaction and then send it to the validator. Validator will check, okay, you are using these 2 calls. You are using these 2 calls, and then the signatures from the owner of these 2 calls are there. And then the values of the input calls and the values of the output calls are the same. So this is not an overspending. So the validator says that this 2 calls is fresh, not yet spent. So the validator will sign this, and after that, this transaction is completed, so the sender's bank will send this to the receiver's bank. The receiver's bank says, okay, this has been signed by the validator, so it knows that this is a valid transaction. Now, the validator, again, is proof of unspent coin. So this is the two new coins created by that transaction. So this is the validator maintains the set of coins that has not been spent yet. Now, this is a diagram representing a sequence of transactions, and this is the format used in Oral 1.0. Now, there are two issues. The first one is that, well, it does not offer much privacy. There is some basic identity privacy because the so-called pseudonym of the so-called user just identified by their public key. So the bank knows their public key, but when other people observe the transaction, they know, okay, this is the guy. I don't know who this identity ID is. And the other issue is that, well, the transaction amount is also liquid, and also I know the payee ID when I observe the set of transactions. So it doesn't offer full ID privacy, no transaction privacy. So let me just go to the things that we have already completed. So we define a pseudonym mechanism, and then it allows people to generate their own pseudonym. Actually, this is using anonymous credential in such a way that everyone can verify this pseudonym is legitimate. It comes from a user who has registered in the system. And also, the key part is that there is an encryption of the long-term public key of the owner in the pseudonym, so that the authority can decrypt this part and get the long-term public key, and the public key is small enough to fit into this pseudonym is small enough to be transmitted through a QR code. I don't have time to go through what we have done using CKP, but one thing I would like to emphasize is that, well, CKP is powerful, but if we want to use it in practice, the biggest issue is that it's very computationally expensive to generate, and users are used to using their mobile phone to carry out transactions. Now, there are some trade-offs. If you ask the PS bank to generate the pseudonym first for the user, then that means the PS bank needs to know your private key, everything. That means you trust your bank. If you want your mobile phone to generate a CKP, sorry, your mobile phone is not powerful enough. So what we have done is actually some kind of trick to separate the generation of CKP so that the private key part is still generated in the mobile device, so the CKP can still be generated in collaboration with the bank. So in this case, the user does not need to share the private key with the bank. Sorry, out of the time. So what we have talked about today is, well, the technology is something I believe for privacy is important and also it's crucial to have privacy by design, and we need to be we need to be transparent about the design so that people can indeed, the central bank is not using that scheme to monitor our daily spending, to give people confidence that, okay, feel confident to use this. We are not using this to monitor your daily spending habit. So I guess I have to stop here. Thank you so much for your listening and questions and comments are welcome. Thank you.
Thank you for your interesting presentation. If I use a bank card, I can go to a bank counter and get a new one. If a user loses their secret key, is there a way to still get access to their funds, like with physical identification from recovery?
Thank you for this question. You asked exactly the same question as the guy from the Bank for International Settlement. They also asked that we present this design to them. Okay, we have two solutions. One is the not so desirable, but they are okay. So if I lost my secret key, I go to the bank to declare that I lost the secret key, and they say, okay, it's okay, ask the validator to simply sign, because the bank knows your balance, so ask the validator to simply sign across to you as a non-technical solution. And a more technical solution is when the user registers their long-term key with the bank, they have to use a cryptographic technique known as verifiable encryption to encrypt a copy of that key to maybe to the bank as well as to the central bank, so that these two guys together can recover your secret key. So this is more a technical solution. Of course, it will increase the burden of the central bank and the bank. Somehow the central bank is a little bit reluctant. I don't want to keep your secret information, even though you say this is like only your partial key. You need to work with the bank to recover the full key, but that means I'm responsible for this thing. And what happens if I lost this part, then you may shoot me for that. So they are a little bit reluctant, but we're also pushing for that.
Thanks. It's a challenging problem, I think. Thanks. Thanks, Prof. Without the presentation of Project Arum. So, in the ZKP implementation, if the private key is not held by the customer, this is the customer trusted bank, so the bank actually held the private key. Does that improve the implementation of ZKP, and does it improve the performance also?
The performance will be much better if you allow the bank to own the user's private key, because as you can see, the zero-knowledge proof needs to prove a few things, including not overspending, including this coin owner has signed the stuff. So if the bank knows the secret key, it can simply generate zero-knowledge proof that, okay, I know the secret key of that coin. That's a much easier secret key. But this is not desirable because it means that the bank can actually spend the money without your consent. So we have to separate the generation of the secret key so that the part related to the user secret key is generated in the mobile phone. But still, it's doable. So not that expensive. So I think this is one of the main technical challenges that we solve in this project. Thank you very much.
Hi, I'm from a traditional finance space, so I just want to understand the concept from an EML KYC perspective. So the way I've understood, I only joined the last 15 minutes, the way I understand is that the customer has to be onboarded by the bank or a licensed entity. So the KYC is done by the bank. So the bank then issues the key along with the central bank. Am I right, Sophie?
Okay, the first part is correct. The user needs to go through the KYC with the onboarding bank, and then the user generate a public key private key pair. The public key will be sent to the onboarding bank. The onboarding bank, after carrying out the KYC, will issue a certificate, kind of like certificate on this public key.
Okay. The private key is held by the individual itself. Exactly. Right. So from a custody perspective, it's a self-custody in that sense, safekeeping of the private key. Am I right to say that?
Sorry?
The private key itself, because some institutions do custody of private key and other key management as well. So in this case, it will be self-custodized, right? Okay, and then the bank would also need to do a KYC on the validators. Am I right to say that? Yeah. Okay. So this is interesting. We'd like to talk to you more about that.
Discuss more offline because we do face a lot of challenges.
Yeah, there's a high space, and then we're getting into this space. How